You had an interview with Bloomberg News yesterday. It was really, really interesting about the risk that maybe this Fed does not do enough. Can you talk to us about that risk?
Yeah, I can't get 2006 out of my mind. The Fed had raised rates from 1% to 5.25%, 425 basis points. Here we are today. They've raised rates by 425 basis points. And then they stopped. And was it enough or wasn't it enough? It took a while for things to slow down, and ultimately it ended in the financial crisis. But they got to 5.25. We're still at 4.25. Will they get to 5%? I think there's still a lot going on. The labor market's tight. China's reopening. The housing market, although prices are coming down, the competition for houses is still very, very high.
So how conservative are you when it comes to this rally that we're seeing emerge in the last couple of weeks, the last few months?
Well, we've been part of it. We thought at the end of last year the markets were ripe for a rally. I was out meeting lots of clients in a lot of places, and a lot of them were telling me they're going back into the bond market for the first time in a while. And they didn't mean a year. A lot of them meant for the first time in 7 to 8 years, but a lot of them were saying this is the first time they've been in the bond market since the financial crisis. So there was a lot of money desperate to get into bonds, waiting for high real yields. They got it. It's come in. The Fed's thrown a lot at this market. They're probably ripe for a pause. I think the market runs a bit more, and then it pauses when the Fed pauses.